Imagine waking up tomorrow, and the money in your wallet is suddenly worthless. The numbers in your bank account mean nothing. Your savings, gone. Your salary, meaningless. This isn't a dystopian movie. This has happened before, more times than you think. And the question is, what triggers a currency collapse? And could it happen again, maybe even to the dollar? Pause for effect. Zoom in on a single banknote tearing apart. Today we're diving deep into the story of currency collapse, the origins, the rise, the breaking point, and the devastating fallout. And most importantly, we'll uncover the hidden lessons that every citizen and every investor needs to know. Currency has always been the lifeblood of an economy, but throughout history, it has also been a fragile promise backed by trust, government, and stability. When that promise fails, chaos follows. And the patterns are strikingly similar across centuries and continents. From the hyperinflation of the Weimar Republic in 1923 to Zimbabwe in the 2000s, and even Venezuela today, one thing is clear: currency collapse is not random. It's a slow-moving disaster fueled by political decisions, economic mismanagement, and sometimes greed. But here's the twist. While it may seem like these events are isolated tragedies, the underlying mechanisms are repeating, and yes, some of the same warning signs exist in major economies today. To understand a collapse, we first need to understand how currencies rise and thrive. Modern money, whether it's dollars, euros, or yen, relies on three key pillars: trust, scarcity, and government backing. Trust is perhaps the most fragile. People need to believe that a note in their pocket can buy something tomorrow. Scarcity gives money value. It must be limited, otherwise inflation erodes it. And government backing provides the official promise that this piece of paper is legal tender, recognized across the nation. But even the strongest currencies are vulnerable. History shows that governments, when pressed by wars, debt, or political pressures, often overstep the delicate balance. They print more money to pay bills, fund programs, or service debt, and that's when the seeds of collapse are planted. Take Weimar Germany, for example. After World War I, the country owed massive reparations. The government printed trillions of marks to pay off debt. Within months, prices doubled every few days. People carried wheelbarrows of cash to buy bread. Trust evaporated, scarcity vanished, and the currency became worthless. Currency collapses rarely happen overnight. They build up quietly, often unnoticed, until panic sets in. Economists call it hyperinflation. But for everyday people, it's simply the moment when money stops working. Let's look at Zimbabwe. In the early 2000s, land reforms and political turmoil disrupted agriculture, which was the backbone of the economy. The government responded by printing more money to cover deficits. At first, the inflation was mild, almost invisible. Then, within a few years, it became astronomical, prices doubling daily, banks refusing deposits, and savings wiped out. The key pattern is the same. A government faces pressure, prints money, and the economy's underlying productivity doesn't keep up. The result? A rapidly depreciating currency that loses its core purpose. And it's not just historical. Venezuela, once the richest country in South America, faced a similar trajectory. Heavy reliance on oil exports, collapsing production, and excessive money printing turned a bolivar into a junk. Millions fled, basic goods disappeared, and trust in money disappeared entirely. So, what actually triggers a collapse? It's not just printing money, it's the breaking of trust. Once people stop believing that their money will hold value tomorrow, behavior changes. They rush to spend it as fast as possible. Savings are liquidated. Hoarding begins. Black markets emerge. Prices spiral out of control. Banks can't keep up. And a collapse accelerates like a landslide. In Weimar Germany, at its peak, a loaf of bread could cost 200 billion marks. In Zimbabwe, hyperinflation reached 89.7 sextillion% in 2008. And in Venezuela, the average citizen spends half a day just queuing for basic groceries. It's not just numbers, it's lives turned upside down. Currency collapse doesn't just hurt wallets. It destabilizes societies, erodes governments, and can even reshape geopolitics. In Zimbabwe, doctors were underpaid and worthless dollars, hospitals closed, and life expectancy dropped. In Venezuela, the middle class vanished, crime soared, and millions emigrated. And Weimar Germany, hyperinflation contributed to political extremism, ultimately paving the way for Hitler's rise to power. The lesson is clear. When money fails, The ripple effects touch every aspect of society from politics to daily survival. It's a humanitarian disaster disguised as an economic problem. After a collapse, governments often scramble to restore order, but solutions are rarely simple. Sometimes they issue a new currency. Sometimes they peg the currency to a stronger foreign currency. Sometimes they impose strict price controls. But history shows these fixes often fail at first. In Zimbabwe, the government introduced the Zimbabwe dollar multiple times, but without restoring trust, the cycle repeated. In Venezuela, attempts to revalue the bolivar barely slowed the inflation. In Weimar Germany, it took an international loan and a complete monetary reform to stabilize the mark. The key takeaway: printing more money, controlling prices, or issuing new notes can't fix a system when trust is broken. Trust and the economy's productivity must be rebuilt from the ground up. So, why are we telling you this today? Because these aren't just historical stories. The same patterns can appear anywhere. Look at the data. Global debt is at record highs. Central banks are injecting trillions into the system, and inflation is hitting multi-decade highs in some regions. The question isn't whether collapse will happen, but where, when, and how severe it could be. Even strong currencies like the US dollar are not immune. While the dollar remains a global reserve currency, history reminds us, no currency is invincible when trust erodes and fiscal discipline fails. In the next part, we'll dive even deeper. The hidden mechanisms that accelerate a collapse, shocking examples of modern-day currency failure, and 3 clear takeaways every citizen must know to protect themselves. We'll also explore whether history is about to repeat itself in ways you might not expect. Trust, scarcity, and government backing. What happens when the pillars crumble? The answer is more terrifying and more urgent than most people realize. Previously, we explored how currencies rise, how they collapse, and the devastating impact on societies from Weimar, Germany to Zimbabwe and Venezuela. But now, we need to face the uncomfortable truth. These aren't just isolated tragedies. The same forces exist today, quietly building under the surface. And the patterns are eerily familiar. In this second part, we'll uncover the hidden triggers that accelerate collapse, expose shocking modern examples, and reveal 3 critical takeaways to survive or even thrive if history repeats itself. Currency collapse is rarely accidental. It's a slow-motion disaster, but certain mechanisms can accelerate it once the system is stressed. First, excessive debt. Governments that borrow heavily often fund deficits by printing more money. At first, this seems harmless. Quantitative easing or stimulus programs are designed to stabilize the economy. But if growth doesn't keep pace with debt, inflation spikes, and faith in the currency erodes. Second, economic shocks. Wars, sanctions, mismanagement, or sudden drops in key exports can destabilize economies. Venezuela relied almost entirely on oil. When oil prices collapsed, so did the government's ability to sustain the currency. Third, psychological panic. Once citizens believe their money will lose value tomorrow, behaviors change. Hoarding, foreign currency purchasing, and black market trading accelerate the collapse faster than economists can model. It's a feedback loop. Fear drives action. Action drives price spikes. Price spikes intensify fear, and the spiral becomes unstoppable without radical intervention. Let's look at the numbers. In 2023, Venezuela's annual inflation rate was over 1,000%. Zimbabwe's inflation, though temporarily lower than its peak in 2008, still destabilized the economy for years. But even outside these extreme cases, modern economies show warning signs. Argentina has faced chronic inflation for decades. The peso loses value almost yearly, forcing citizens to buy dollars, gold, or even Bitcoin to preserve wealth. Turkey, until recently, saw its lira drop 90% against the dollar in just a few years due to political interference in monetary policy. Even countries traditionally considered stable are not immune. Debt to GDP ratios in the US, Japan, and the EU are at historic highs. Central banks hold interest rates near zero or negative for extended periods, encouraging borrowing and reducing the incentive to save. These factors create pressure on trust, the same pillar that broke in Weimar Germany. And consider this, over 90% of money in modern economies exists digitally, numbers on screens, not physical cash. Trust in banking systems is more fragile than ever. If confidence falters, a digital currency collapse could trigger panic faster than paper money ever could. So what can you do if the warning signs start appearing? History provides a roadmap for survival. 1. Diversify assets. Cash can vanish in value, but tangible assets like gold, silver, real estate, or commodities often retain purchasing power. Even foreign currencies can be safer during domestic collapse. 2. Maintain liquidity and essential stockpiling. Basic necessities, food, water, medicine can provide a buffer while the currency fluctuates. Those who hoarded resources during Zimbabwe and Venezuela crises survived far better than those relying purely on money. 3. Protect income streams. Relying solely on a salary denominated in a collapsing currency is dangerous. Businesses, investments in hard assets, and income sources in stable currencies can mitigate risk. 4. Understand psychology. Panic spreads faster than inflation. Avoid herd mentality, but act proactively. Early preparation while trust is still intact matters far more than reacting when the collapse is already underway. Here's a striking fact. During Zimbabwe's 2008 hyperinflation, the central bank printed notes as large as $100 trillion, yet the cost of a loaf of bread could still exceed $1 trillion. In Venezuela today, families spend hours queuing for basic groceries, often using multiple forms of payment, from foreign cash to mobile apps and barter. The lesson: when money collapses, convenience and normalcy vanish. Even in moderately stressed economies, inflation is quietly eroding purchasing power. In the US, average inflation-adjusted household savings have declined for decades. Food, housing, and healthcare prices rise faster than wages. While not a collapse yet, these trends hint at a repeat of past mistakes scaled differently. If we zoom out, the patterns are almost identical across time and place. Excessive money printing, economic shocks, declining productivity, and loss of trust. Whether it's Weimar Germany, Zimbabwe, Venezuela, or modern high-debt nations, the mechanics are shockingly similar. And each time, the consequences were devastating for ordinary citizens. Governments may attempt to intervene with reforms, new currencies, or fiscal policy adjustments, but without restoring confidence, collapses can linger for years. 3 clear takeaways. So, what can you take away from this? 3 critical lessons stand out. Trust is everything. A currency is only as strong as the collective belief in it. When trust erodes, even the strongest currency can spiral into chaos. Diversify and prepare. Cash alone is not enough. Tangible assets, foreign currencies, and basic essentials provide resilience against economic shocks. Watch for repeating patterns. History is not random. Rising debt, excessive money printing, and economic mismanagement often precede collapse. Awareness allows you to act before panic sets in. Here's the uncomfortable truth. No economy is immune. Even the dollar, euro, or yen could face serious stress if fiscal discipline falters and trust declines. The difference between survival and hardship is preparation, both financial and mental. The question isn't just, could it happen, but are you ready if it does? If this video opened your eyes to the fragility of money, share it with friends and family. Discuss it, plan ahead, and educate yourself. And don't stop here. Subscribe for more insights into how economies, money, and wealth really work in our modern world. Knowledge isn't just power, it's protection. Because when a currency collapses, preparation isn't optional. It's the difference between survival and chaos.